Warren Buffett wrote more than 50 years of shareholder letters, and across hundreds of pages, he rarely said the most important things out loud. What if I told you the real rules Buffett followed were written between the lines? Not in formulas, not in bolded policy statements, but in omissions, tone, and repetition. Stay with me. By the time he went quiet in late 2025 and handed the keys to Greg Abel in 2026, many of those unspoken rules were already baked into Berkshire, and a few depended entirely on Buffett's personality. Which ones survive and which ones won't? That's what we're unpacking. Over 5 decades of annual letters, Warren Buffett taught investors by storytelling, metaphor, and example. This narration pulls 10 Buffett rules he never says out loud: implicit habits, rhetorical omissions, tonal cues, and inferred allocation priors that actually explain Berkshire's results more than any single chart or ratio. We'll tie each rule to recent events. Buffett's November 2025 note, where he said he'd go quiet. The formal succession to Greg Abel at the start of 2026 reports that Abel's 2026 salary was raised to roughly $25 million, and Buffett's multi-billion-dollar lifetime donations in 2024 and 2025. Quick disclaimer before we dive in. This is educational content only, not financial, legal, or investment advice. Now, ready? Let's surface the unspoken playbook. Rule 1. Buy businesses, not stocks, the principle, not the formula. Buffett rarely handed readers a spreadsheet that said buy at X price to earnings. Instead, he framed Berkshire's purchases as acquisitions of durable businesses, the Coca-Colas and Geicos that can be held forever. But he almost never prescribed a mechanical valuation cutoff. Why? Because the rule is behavioral, not mathematical. It's about refusing to turn a business into a ticker when you think clearly about long-term economics. Remember how Buffett described his circle of competence and said you should know what you own and why you own it? That's not a valuation formula. It's a cognitive constraint on investment errors. He did discuss repurchases and mentioned price discipline, only buy back when the stock is under intrinsic value, but he never quantified intrinsic value for shareholders. Why leave it implicit? Because he wanted owners to think like owners, not quants. Rule 2. Think in compounding, not quarters the patience play. Buffett's letters are a masterclass in temporal framing. He constantly reframes success as the product of patient compounding and avoidance of permanent capital loss. He used examples Berkshire's multi-decade holdings rather than spreadsheets to demonstrate the power of time. But here's the subtle omission. He rarely gives a list of time-based rules like hold at least 5 years. Instead, he instills a mindset. Treat the business as if you might own it forever. Why does that matter now? Because as Buffett goes quiet, the institutional memory of patience must be passed on. Greg Abel isn't just getting the CEO title, he's inheriting a culture that values horizon. What if management incentives pull toward shorter horizons? We'll touch on that when we discuss compensation. Rule 3. Conservative leverage, aggressive optionality, implicit risk limits. Buffett talked a lot about insurance float and the magic of leverage when used conservatively, but he never published strict leverage ratios or value-at-risk limits for Berkshire. Instead, risk posture was communicated via examples, underwriting discipline, stories of past mistakes, and a consistent refusal to over-lever the holding company. The omission is the rule. By not giving hard leverage numbers, Buffett forced readers, managers, and analysts to infer limits from behavior. Berkshire's balance sheet showed conservative use of debt relative to peers. When pressure comes, the ability to avoid forced sales is what keeps compounding alive. But if someone changes the default, say, to chase yield with higher leverage, compounding can be at risk. Rule 4. Decentralize, but hire with intense vetting, the delegation paradox. Buffett repeatedly praised decentralized management. His letters seldom prescribed daily operations. Instead, they praised the autonomy of managers and the company's owner-friendly operating structure. But decentralization only works if you hire the right people you trust implicitly. He didn't publish a step-by-step hiring manual. The implicit rule was cultural. Hire managers with integrity and long-term mindsets, then get out of their way. That reliance on character means succession tests whether the company can replicate Buffett's implicit hiring filter. When Greg Abel was elevated, the succession was signaled through repeated positive references over time, rather than a single decree. If the culture depends on character, what happens when the chief culture carrier retires? That tension is central to the next rule. Rule 5. Communicate with plain language, but not too much tone, as a governance tool. Buffett's tone, plain-spoken, self-deprecating, anecdotal, did important work. It reduced information frictions, built trust, and substituted for formal disclosure in many cases. Yet he also withheld certain things: detailed playbooks, explicit succession instructions, or exact donation timing. Those omissions were deliberate. Tone can be institutionalized, but it's fragile when tied to a single personality. Buffett's November 2025 Thanksgiving letter, saying he'd go quiet, removed a signal, the annual voice that calibrated investors' expectations. How do you replace that voice? You can't print it into a policy. It either survives in the culture or it fades. Rule 6. Use share repurchases as a safety valve, not a growth engine signaling through practice. Over time, Buffett used buybacks as a tool only under disciplined circumstances, when shares were cheap relative to intrinsic value. Again, he never published a formal buyback threshold. Berkshire's behavior created expectations. This behavioral consistency mattered more than a memo. When a company repeatedly repurchases at sensible prices, the market learns the threshold implicitly. Now, with Abel at the helm and higher reported pay, will repurchase discipline remain intact if the signal of modest pay is weakened? That's a concrete tension, a rule built on behavior and reputation, not legal policy. Rule 7. Give away power philanthropy as governance. Buffett's large lifetime donations are more than charity. They are a governance lever. From 2024 to 2025, he accelerated gifts, including a reported $6 billion donation in mid-2025. And by mid-2025, reports indicated he had given away over $60 billion cumulatively. Those actions reduce concentration of future voting power and telegraph a long-term view about stewardship. Buffett never wrote a manifesto explaining his donation strategy in granular legal terms in the shareholder letters. Instead, the gifts functioned as a signal. He was transferring wealth and influence in a phased manner. That's an unspoken succession tool, a way to decouple personal wealth from corporate stewardship. Rule 8. Modest executive pay was a signal, not a rule. Compensation as a cultural lever. Buffett's personal modesty and reluctance to inflate CEO pay were part of Berkshire's messaging. Historically, top executives at Berkshire were paid modestly relative to peers, a signal that management should act like owners. But that signal shifted with Greg Abel's reported 2026 salary of roughly $25 million, one of the highest for an S&P level CEO. Buffett never wrote, "We will cap CEO pay at X." It was an implicit norm. When a new CEO receives materially higher pay, that implicit signal is diluted. Does that mean decisions will immediately change? Not necessarily, but it changes incentives and perception. Rule 9. Capital allocation is a habit, not a policy. Patterns over documents. Read every letter and you discover capital allocation expressed through repeated examples. Reinvest in high-return subsidiaries, buy back when undervalued, and opportunistically acquire large businesses when the price is right. Buffett rarely codified a rigid policy. Instead, he demonstrated a set of priors via consistent actions. Actions speak louder than words. After Buffett stepped down from his annual letter rhythm and Abel took over, the institution's prior favoring durable economics and low leverage had already been embodied in boards, subsidiary contracts, and the investment team. That's why many of these unspoken rules persist, because they're institutionalized through behavior, not memos. Rule 10. Teach mental models, not checklists, tacit knowledge, as the core asset.